One of the main reasons why sometimes when you take a particular trade, there is no guarantee that you come out with a profit on that particular trade is because you don't know how to trade your stops. Or one of the main reasons why you take a particular trade in Forex, the trade will go your way, then after a couple of minutes or a couple of hours based on the time frame you are using, you see the market will go against you, trigger your stop loss, then continue to go in the original intended direction. I know that sucks, right? That sucks, and that is because you don't know how to trade your stop loss. Or even if you know how to trade your stop loss, you don't know how to trade your stop loss like the professionals do. So on this video, I want to show you guys step by step on how I am able to trade my stops, for you to be able to see me coming out with a trade with the risk to reward of 1:3, 1:4, 1:5. So make sure you stay to the end of the video so that you can be able to see the secrets you need to be able to implement when trailing your stops effectively in Forex trading. What's up, guys, and welcome to the channel. My name is Ndemazeah Godlove, and on this channel we talk everything about trading, business, personal finance, and tips to help you stay profitable on a consistent basis. So if this is your first time coming to my channel, make sure you smash that subscribe button to subscribe to the channel so that you can always be updated with awesome content like this. So the steps are just going to be very, very simple, right? I'm just going to be sharing my screen in about a minute so that I can show you guys the step, and I'll make the video as short as possible so that I can pass out the point across. Good. So before we even begin, what is a trailing stop? A trailing stop is just an automatic. It can either be an automatic trailing stop or a manual trailing stop, all right? So a trailing stop is just a risk management measure that protects your profit anytime you're in profit, all right? So anytime, let's just say you are targeting 100 pips and the market goes in your favor for maybe plus 30 pips or plus 40 pips. The only thing that will help you to be able to prevent the market, to be able to prevent those trades or those profits from just disappearing is what they call a trailing stop. Because the market can go in your favor for plus 50 pips, but don't be surprised. You see the market will go against you, even past the entry point, trigger your stop loss, or even blow your account sometimes. I don't want that to happen to you. I don't want that to happen to any of my subscribers. That doesn't happen to me because I have been able to catch this secret, all right? So that is just a trailing stop. A trailing stop just automatically or manually protects your profit anytime you are on a profitable trade. Perfect. So after knowing the definition of a trailing stops, of a trailing stop or of trailing stops, let me share my screen with you so that I can just show you guys a quick demonstration of the rules, because this is rule based. Remember, a strategy must be rule based. There must be some rules in your strategies or in your strategy that you follow. So when it comes to trailing your stop loss effectively, this is 100% rule based, and you need to follow these rules without derailing from your particular rules. Okay, so as you can see on my screen, let me use this whiteboard to be able to show you guys the steps. Remember, I mentioned of the rules, right? So let me use this whiteboard to show you guys the rules. Then I'm going to use a live chart to be able to show you guys examples or step-by-steps on how I will be able to trade my stop. The first thing you want to be able to determine when you want to trade your stops effectively is the risk involved on that particular trade, all right? So that is the first thing you have to determine, which is what? Which is the risk. So what is the risk on that particular trade? What is the risk on that particular trade? That is the first thing you have to determine. Then the rule states that the distance between the current market price and your stop loss must always be 2 arrows. That is the golden rule. All right, I'm going to be able to show you guys in a minute step by steps on the chart. So long as you follow these rules, 99% of the times there's not going to be a time where you suffer from stop loss hunting or spikes or hikes or whipsaws or anything of that in the market. All right, so make sure the first thing you determine is the risk. What is the risk? What are you risking on that particular trade? Then secondly, the golden rule states that the distance between the current market price at any point in time and your stop loss must always be 2 arrows. So let's just assume the market is bouncing down, right? The market is bouncing on lower highs, lower low, lower highs, lower low, which is in a clear downtrend. And we saw somewhere here, we saw somewhere here, we saw somewhere here. and the market starts going in our favor. Let's just assume our stop loss is somewhere here on 20. Let's just assume we are risking 20 pips on this trade, and we are going for maybe plus 60 pips. All right, good. So what does the rule state? What is the first thing you're supposed to do? You're supposed to ask yourself what you are risking on that trade. What is our risk on this particular trade? Our risk on this particular trade is 20 pips. That is the risk on this particular trade. Then the golden rule. So before we ever touch our stop loss at any point in time, the market is supposed to go in our favor for 2 arrow, right? So the market, so long as the market is still below 40 pips, still below plus 40 pips, we are not supposed to start to touch our stop loss. But so long as the market has already gone in our favor for maybe plus 40 pips, then that is already 2 arrow. Then we will then move our stop loss from the stop loss level to break even. All right, at that point in time, the distance between the current market price and the stop loss is 2 arrow, which is plus 40 pips. If the market goes down again by plus 20 pips, now we are on plus 60 pips, right? What is the distance between the current market price? What is 2 arrow? 40 pips. So now I'll remove my stop loss again here, and I'll put down on plus 20 pips. At that point, from plus 20 pips to plus 60 pips, you can see the distance between plus 20 pips and plus 60 pips is plus 40 pips. So at any point in time, the distance between the current market price and my stop loss must always be 2 arrow. What are the reasons why the distance between the current market price and my stop loss must always be 2 arrow? The first reason is to give my trade room to breathe. All right, I used to call it room to breathe. So it is to give my trade room to breathe. That is the first reason why I want to be able to put the distance between the current market price and my stop loss to always be 2 arrow, to give my trade room to breathe at any point in time. Because if you don't give your trade room to breathe, you're going to suffocate those trades. That's the reason why you see most of the time when you are in profit, you just tremble. Maybe you don't even have a rule-based system where you are using to be able to trade your stop. You tremble, and maybe you shift your stop loss up a little bit, and at that point in time, maybe there's a fundamental news or there is a spike in the market, and boom, the market comes against you, trigger your stop loss, and continue in your intended direction. I know that sucks. I know that is very, very irritating, but that will happen to you 80% of the times in your trade if you don't know how to give your trade room to breathe. If you don't know how to give your trade room to breathe, this will happen to you time without number. You must always try as much as possible not to suffocate your trade, because that is why, let's just assume you see the market is going up, it's bouncing on higher lows, on higher highs, higher lows, higher highs, higher lows, and maybe you bought somewhere here, right? At this point, you bought somewhere here, you buy somewhere here, and the market goes in your favor for plus, let's just say plus something like plus 80 pips, right? And maybe you are targeting something like 200 pips. You immediately just shift your stop loss and you put somewhere here at break even. You see the market comes back somewhere here, past break even, then continue going back. At this point in time, you're already out of the trade. So even if the market is continuing to go in your intended direction for plus 10,000 pips, you are already out of the trade. You've already lost that trade. You might even blow your account. That is because you don't know how to trade your stop. What is the first rule when you want to be able to trade your stops effectively? Determine your arrow. Your arrow stands for the risk on that particular trade. That is the first thing you want to determine. After you've been able to determine your arrow, at any point in time, before you ever trade your stop, before you ever shift off your stop a little bit, the distance between the current market price and your stop loss must always be 2 arrow, which is 2 times your risk. So if I'm risking 100 pips and I press buy on a particular trade, I won't touch my stop loss unless the market has gone in my favor for plus 200 pips. Then I'll shift my stop loss and put on break even. That trade will be now on break even. If the market goes in my favor again for plus 300 pips, I'll then shift my stop loss and I put on plus 100 pips. At that point in time, the distance between the current market price and my stop loss is always 2 arrows. So I'm giving my trade room to breathe. I'm not suffocating my trade. I won't suffer from stop loss hunting. I won't suffer from market makers trying to trigger out my positions. I will still be on that particular trade. So those are the golden rules you follow anytime you want to trade your stops effectively in Forex trading. Now let's go on this particular live chart, right? Let me delete this. let's just use this particular live chart. It's a Euro USD. It's a USD Japanese yen chart, which I personally look for this because I traded this particular setup about 4 months ago and I made almost about $5,000 on this setup alone. So let's just assume in the market, depending on how you are drawing your support and resistance, we have something like this triangular pattern. Then we know very well because this is a daily time frame, let's just assume we've already done our analysis on the weekly time frame, and we know that anytime the market breaks this particular resistance, we're going to be buying. As simple as that. Anytime the market breaks this particular resistance, the resistance is going to become our support and we're going to be buying. Do you understand? That is why there's always, you must always have at the back of your mind that no matter the market is going up or coming down, there's a potential for a change in structure. So we are waiting for a change in structure here, and let's see if the market is going to be able to go in that particular direction and what would have done. Let's just assume, according to our analysis, if this market breaks this particular resistance, we're going to be going for a risk to reward of 1:5. All right, of 1:5. Let me show you how you would have trade your stops to prevent the market from coming against you, to trigger your stop loss, then continuing in the original direction. Let's just play. Let's go ahead and see. All right. So let's bring in our tool, the long tool. Let's just assume our plan is to go long somewhere here. Our stop loss somewhere here at minus 250 pips, at minus 250 pips, and we're going to be going for a risk to reward of 1:5, which 1:5 should be around 250, 500 should be about 1,000. Let's just go up and see. Should be around 1,250 pips, right? So 1,250 pips is somewhere here. All right, good. So that is that, a risk to reward of 1:5. So I can then put this particular arrow here so that we know where we're going to be going out of that particular trade. We're going to be going out somewhere here. All right, good. And we are risking 250 pips on this particular trade. Now let's play one candle at a time to see what would have happened. Good. You can see the line is not yet broken, right? The line is not yet broken. Our resistance is not yet broken. According to this strategy, as soon as the resistance gets broken, I'm going to enter in that particular trade. Boom. We are already on the particular trade, and remember, this is the 4-hour time frame. So I want to be able to show you when you would have touched your stop loss. Remember, we are risking 250 pips, and we are going for almost about 1,250 pips. So remember, I said before you touch your stop loss, the market must go in your favor for at least 2 times your arrow. What is our arrow here? Our arrow here is equal to what? Our risk here is equal to 250 pips. So that is our risk, our 250 pips. So 2 arrow of this is going to be obviously 500 pips, right? So before we even touch our stop loss, the market must go in our favor for 500 pips. So let's come back here and let's bring down these 2 and put on 500 pips. This is 500 pips somewhere. This is 500 pips somewhere here. Okay, so you can see this is 500 pips somewhere here, and our stop loss is right here. So at this point in time, you can see we are already in a trade. We are already in a trade of almost about 50 pips, but I'm not going to do anything. I'm not going to tremble. I will see 50 pips plus 50 pips, but I'm not going to tremble. I'm just going to wait. The first thing, my risk is 250 pips. So before I touch my stop loss, the market must go in my favor for 2 times my risk, which is 500 pips. So let's play and see what would have happened. Boom. The next candle, we are still in profit. We are still in profit. The market is still going in our favor. So let's keep going. You can see, guys, that's the market going up. At this point in time, boom, we just hit 500 pips. Remember our target, this is our take profit right up here. At this point in time, we just hit 500 pips, and since the rule states that before we trade our stops, the distance between the current market price, which is this level, and our stop loss must be 2 arrows. So the distance between this point and this point is 500 pips, which is 2 times our risk. So at that point in time, I just drag my stop loss and I put at break even. Now, voila, this is a free trade. All right, so even if the market has to come again, it has to go against me, this trade will never be a loser again. The worst case scenario, even if the market has to go against me, there is no way this trade is going to be a loser. Worst case scenario, I'm going to come out at break even. So at that point in time, you can see my stop loss is somewhere here. Now let's replay and I'll show you when you would have pushed your stop loss up again. Let's keep replaying. Now we need to then look for, the market has to go in our favor again for plus 250 pips, which is going to be around 750 pips. 750 pips is somewhere here. So let's play and see. Good, you can see that's the market going in our favor. Now we have a retracement, boom. We just hit 750 pips, which is now 1 arrow. The market has just gone in our favor again for plus 1 arrow. And the distance between the current market price and the stop loss must be 2 arrow. So 2 arrow now, we shift the market, we then push our stop loss up to maybe plus 250 pips. Now we already have 250 pips blocked. Let's measure the distance between our stop loss is somewhere here and the current market price is where? Is here at plus 750 pips, all right? So now that is the effective way for us to put our stop loss, because even if the market has to go against us, we already have plus 250 pips. So this trade is going to be a winner. Plus 250 pips we've already blocked in. Let's go up again. Let's push up again to plus 1,000 pips, right? Plus 1,000 pips should be somewhere up here. Let's just put this level at take profit. So now remember, we are already here at plus 750 pips. And as soon as the market keeps going in our favor, for plus 1 arrow, we're going to be shifting our stop loss. So let's play and see what would have happened. You can see there, we see the market started dropping, but we won't tremble, because see, this is our stop loss standing here. So even if the market is retracing against us, we wouldn't mind, because our stop loss is standing on a reasonable distance. Just imagine if your stop loss was somewhere here, you would have already been triggered out of this particular trade. That is the reason why you need to learn how to place your stop loss effectively or trade your stop loss effectively. Let's play and see what would have happened. The market is still trying to form a higher low. Remember, anytime you place a trade, the market always breathes in and breathe out. Breathe in and breathe out. It's the same thing. So now the market is trying to form a higher low. Let's play and see. The higher low, now the structure is resuming the normal trend. Let's go. Let's keep going. You can see the market is going up. Boom. Now we just hit again another key level of plus 1,000 pips. Remember, plus 1,000 pips here, and we are targeting plus 1,200 pips. So since we've gone up again by plus arrow, by plus our risk, plus 250 pips, now I'm going to shift my stop loss now to plus 500 pips. My stop loss now is at what? It's at plus 500 pips. Even if the market wants to go against me now, I'll come out with plus 500 pips. Now let's continue, and let's check the distance between the current market price, which is at plus 1,000 pips, to where our stop loss is at plus 500 pips is what? Is 2 arrow, 2 times our risk, and 2 times our risk is what? Is 500 pips. So at any point in time, the distance between the current market price and our stop loss is always 200, is always 2 times the risk, or 2 arrow, which is 2 times 250 pips, which is equal to 500 pips. Perfect. Let's see what the market would have done. Let's keep going. Boom, the market, boom. Now we just hit our take profit. At that point in time, we are out of the trade with plus 1,250 pips. All right, plus 1,250 pips. And before we got to that plus 1,250 pips, you guys all saw how we were able to manage our risk. Let's go back here and go back to this particular tool. You guys have been able to see very clearly how we were able to manage our risks on this particular trade. So that is how you are able to manage your risks effectively in any particular currency pair on any particular time frame. So even if you are using a 5-minute time frame and your target is just 50 pips away and you're risking something like 10 pips, you wait for the market to go in your favor for plus 20 pips and you put your stop loss at break even. The market goes in your favor again for plus arrow or plus 1 arrow again, which is going to be now at plus 30 pips. You put your stop loss now at plus 10 pips. The market goes in your favor again for plus 40 pips. You put your stop loss now at plus 20 pips. So at any point in time, the distance between the current market price and your stop loss is 2 arrow. Now what are you doing? You are giving your market, your trade, room to breathe, and you are not suffocating your trade. You won't suffer from stop loss hunting. You won't suffer from market makers trying to trigger out your positions, and you won't suffer from bigger fundamental impacts in the market. At that point in time, your trade is going to be secured, and 99% of your trade most of the time won't suffer from all these consequences that will cause you to lose your trade. Thank you guys so much for watching to this point in time. If you have gotten some value from this video, make sure you smash the like button on the video, and if you're watching and you haven't subscribed, make sure you smash the subscribe button on the channel. Check out my free Discord community, link on the video description. If you want PayTrace Pro, check the link on the video description. Also check the link on the video description to use my recommended broker. And if you want to hear from me one-on-one, you know what to do. Check out the free Discord community or enroll in Godlove University. Follow the videos that are going to be coming at the end of the screen because they are all related to the same topic, and I'll see you guys on the next video. Peace.